Hello, chart watchers, and welcome to this Wednesday, January 23rd, 2019 Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we got quite a reversal here in the market today. The Dow Jones Industrial Average earlier up almost 300 points is now down 30 points. The S&P 500 down 14. The NASDAQ getting hit harder on a relative basis, down almost 48 points. And the Russell 2000 down about 11 points. 10-year Treasury yield earlier up at about the 2.78% area has reversed and now back down to 2.74%. Volatility on the rise for the second straight day. Haven't seen this kind of increase in volatility in the past 3 to 4 weeks, so this will be something to monitor throughout the day. Currently, the VIX up 0.96 or more than 4%. The materials and energy groups leading to the downside, as you can see today, followed by communication services. So these three areas getting hit. But really all of the market has seen quite a move down off of their earlier highs. In earnings news, IBM came out with a very strong report, certainly on their bottom line. Stock gapped up, traded up near 135, has reversed back down, but still up nicely today. United Technologies was much higher earlier today. Big reversal here. Could be the fact that they lowered their revenue forecast going forward. Their bottom line and their top line for the last quarter, very strong, but they did lower revenue guidance going forward. Capital One really missed badly on their numbers, top and bottom line. We'll talk about these in just a bit. But Erin, you know, we were talking about as we got up, there were some key areas that we wanted to watch for in the market. I know you kept talking about 2,600. I was talking about 2,581, which was the price resistance area. And then those 20-week EMAs, which for the S&P 500 was up near 2,670. And that's right where it closed at on Friday before coming back down this week. We're seeing volatility pick back up. I don't know, short term, we're going to have some key areas. We can talk about some of those in just a bit, but market certainly looking a little weaker now than it's looked in the past 3 to 4 weeks.
I agree with you. Not too good. Well, we've got Jeffrey Saut here, so I'm going to go really quick through the schedule, and that way we can get to him right away. We have Arthur Hill coming in on the 24th. Of course, what's hot, what is not is Friday. We also have Greg Schnell coming in the following week, so that should be fun. And then I have my workshop on Tuesday the 29th. I'm going to do Building Blocks of Technical Analysis Part 2. And then Dr. Alexander Elder will be joining us on the 30th. Very excited to talk to him. Many of you know he's one of my favorite authors out there. All right, for today's agenda, of course, we will be bringing in Jeff shortly. And then we will be doing our technical news and headlines afterwards, followed by the 10 and 10, which is AGNC will be our first symbol that we look at. And finally, we'll finish with Spotlight Stocks. All right, Jeff, without any further ado, let's bring you in. Jeffrey is the Raymond James Chief Investment Strategist. So I know you have some interesting charts to show us and tell us about your market outlook.
We got a sell signal on October 2nd. We wrote about it on October 4th in our Monday morning TAC letter, and basically told people if you have long speculative trading positions, you should sell them. We didn't do anything with investment positions because, quite frankly, I didn't think the selling would be as severe as it was into late December. And the selling was brought about through a combination of things. The hedge funds send out letters on November 15th to their investors, and they give them between November 15th and year end to pull their money back. And so roughly 140 hedge funds closed their doors at the end of last year. So that started the selling as hedge funds liquidated. Then you had mutual fund liquidation because they had a tough year last year. And exchange traded funds got sold. And then on top of that, you had tax loss selling. And that led to 3 of the most intense selling days I have seen in a long, long time. And I've been doing this professionally 48 years this month. The selling climax occurred on December 24th. It was followed by a 90% upside day on December 26th, 90% upside day, meaning 90% of the total volume traded comes in on the upside and 90% of the plus or minus ticks come in on the upside. You had another 90% upside day on January 3rd. Folks, that's the way bottoms are made. So all these people talking about a retest of the December 24th low, I don't think you're going to get it. I don't think the market's going to be that accommodating. In the short run, we think the market has exhausted its internal energy on a short-term basis, and we could see a pullback. I don't think it'll be more than 2,500 to 2,550, if that. If we get some kind of trade resolution, it's probably not even going to be that. But longer term, I continue to think, like I did the last time I was on here, that we are in a secular bull market. And secular bull markets last 14, 15, 18, sometimes 20 years. If you can look at this first chart, this 1949 to 1966 secular bull market, you can run the number of years that was. Were there pullbacks? You bet there were pullbacks. The Jack Kennedy steel crisis, where the steel companies raised prices in 1962, President Kennedy said, you can't do that, and put the prices back down. The equity markets didn't like that, and they lost like 30% in a very short period of time, but it did not stop the secular bull market. And so then we peak in 66, and we basically go into this trading range, although it didn't feel like a trading range. When the market in January 73, right there, closed decisively above 1,000 for the first time, it was 1,051. It would start to decline into its nominal price low, the lowest the index would get in December of 1974. In fact, it lost 47% of its value. Now, if your definition of a bull market is up 20%, and a bear market is down 20%. And I don't buy that. I guess you could call them tactical bull and bear markets. Between 1966 and 1982, there were 9 tactical bull and bear markets. And then you break out of that 16-year trading range in 82, and you start the 82 to 2000 secular bull market. Were there pullbacks? Yeah. You had the 87 crash. I mean, the Dow lost 22% in one day, but it did not stop the secular bull market. And then you peak in the spring of 2000, and you go into another one of these trading ranges. Although the decline from October of 07 into March of 09, if you own an index fund, an S&P index fund, you lost about roughly 56.4% of your money. But then we come back from March of 09, and we finally break out of that trading range in April of 2013. Now think about this. Nobody measures the 82 to 2000 secular bull market from the nominal price low that was made in December of 1974. They measure it from when the averages broke out that 16-year trading range between 1966 and 1982. Everybody wants to measure this one from the March 09 nominal price low, when maybe we should be measuring it from when the averages broke out of that trading range, that 13-year trading range in April of 2013. So here's your 13-year trading range, and here's your upside breakout, confirmation of bull market. That is what a secular bull market looks like. That's 1982 to 2000, up 1,180%. And there were a lot of stocks that did a lot better than that. Now, one of the things my dad taught me was Dow theory, interaction between the Dow transports and the Dow industrials. Not always right, subject to interpretation, but it's right a lot more than it's wrong. And on September 23rd in 1999, there was a Dow theory sell signal. We wrote about it. Told people it's not Jeff Saut, it's not Raymond James, it's Dow theory telling you the best has been seen and discounted. And you ought to raise cash, and you ought to not let anything go very far against you. There was a Dow theory buy signal in June of 03, and then you got another Dow theory sell signal on November 21st of 2007. And then this spike down, and we were bearish at the time, this spike down, the first spike right before the March 09 low, that is October of 2008. And on October 10th of 2008, 92.6% of all stocks traded made new annual lows. I have never seen that happen. I've got data going back into the 50s. I don't think it's ever happened. It might have happened in the 30s. The majority of stocks bottomed in October of 2008. The averages kept going lower because the financials kept going down. But I'm on record in October of 08 saying the bottoming process has started. And then on March 2nd of 09, I think I don't think Bloomberg still has it, but I think that CNBC still has it. I'm on those two stations saying the bottoming process that started in October is complete this week, and we're all in. And we've basically been running with the bulls ever since. There was a false Dow theory sell signal in May, the flash crash 1, May of 2010. We ignored it because we thought it was an aberration. There was a Dow theory sell signal in flash crash 2 on August 24th of 2015. We ignored it. There was also a Dow theory sell signal in mid-December last year, and we ignored it because we thought them to be an aberration. So I still think we're in a secular bull market. I'm running with the bulls. We're a little cautious on a near-term basis. So where are we now in 2019? Well, the stuff that put us in the tank is just not here right now. Peak oil, not anywhere near $150. Manufacturing is actually coming back in the country. There is no housing glut. There is no excessive bank leverage. The only place we see excess is in the fixed income markets. Now, here's where a lot of people make mistakes. They cut off the 1982 to 2000 secular bull market in 87, but that did not end the secular bull market. It went on for another 13 years. They cut off the 1949 to 1966 secular bull market in 1956 because that's when Egypt tried to take over the Suez Canal, and the markets didn't like it. And they lost a pretty good percentage-wise in a very short period of time, but it did not stop the bull market. So that's what I think we're in. Now, this is the typical investor. They tend to buy in the excitement, thrill, euphoria. The market rolls over. They get a chance to manage the risk, which is the key for a successful investor, is managing risk. But they're told that nobody can time the market. You got to ride everything out. And I'm kind of the opinion that nobody can consistently time the market. But if you listen to the message of the market, you sure as heck can decide if you want to be playing hard or not playing so hard. So I'm one of these people that actually think cash is an asset class, and I don't mind raising cash when I think it's appropriate. And they keep riding it down, and down there at the maximum point, they sell. And I've watched them do it for 48 years. It's the only product that I know of where they put it on sale and nobody wants to buy it. It's pretty amazing. Here's something people aren't talking about either. The number of publicly traded companies has declined noticeably. The Wilshire 5000, when it was constructed, had 5,000 stocks in it. At its peak, it had 7,200 stocks in it. It's now got 3,600 stocks. It ought to be called the Wilshire 3600. So if demand picks up, which it will before the secular bull market's over, there aren't as many companies to invest in as there were 10, 15 years ago. Here's your 30-year bull market, 35-year bull market where the yields fell from 15% down to, I think it was 1.35. And between 1945 and 1982, you had a 35-year bear market where the yields went from about 2% to 15.25%. We think the fixed income market, bull market is over. We think the Fed is not going to raise rates very fast, but we do think rates are going to go up. And I don't know if you ever saw the movie Caddyshack, but the judge asked Ty, "What did you shoot today?" And Ty says, "Oh, Judge, I don't keep score." And the judge says, "Well, then how do you measure yourself against other golfers?" And Ty says, "I measure myself by height." So the white line is interest rates. You can see where they peak with tall Paul Volcker. They come down, you get a shorter Alan Greenspan. They come down, you get a shorter Ben Bernanke. And then you get a short Janet Yellen, and rates bottom. And now we got Jay Powell. Proof positive, rates have bottomed. Credit boom is likely to continue. I had a portfolio manager in Seattle about a month ago say, "Well, doesn't it worry you that the Fed's rolling off its balance sheet and the Fed's going to be increasing interest rates?" And I said, "Do you know how much money offshore profits are slated to come back into the country in 2018? And he said, "No." And the number is $700 billion. And that dwarfs anything that the Federal Reserve is going to do. We think you've had some softer economic numbers here, but the economy to us looks real strong. We just don't see all this talk of recession. The participation index indicates that there's no recession in sight for at least 2 years. Inflation is picking up a little, which I think the Fed wants. Business sentiment is strong. It's about as high as it's been since October of 1983. The center chart there is the Consumer Present Situations Index, and it's the highest since December of 2000. If you study that chart, you'll see it has turned down well before any recession, which are those blue bars. Earnings improvement before the corporate tax rate cuts. S&P had an earnings estimate bottom-up operating for the S&P 500 of roughly $141. It looks to us like earnings are going to come in at around 160 to 162. This slide's old. The earnings estimates have come down in recent history. It's around $173 for 2019. But at the recent low, if you use that number, we were trading at about 14.4 times for this year's estimate. So stocks were not all that cheap. And there's a very tight correlation, or R squared, between the direction of earnings and the price of stocks. In fact, correlation is 0.939. That's about as high a correlation as you'll see on anything. I've watched people play games with averages for years. You can pretty much make averages do anything you want, and this is just a demonstration of how it goes. Did you know that the average University of North Carolina geography graduate earns over $1 million more in lifetime income than those from any other school in the country? And this is the reason why. Michael Jordan. Michael Jordan made so much money, he skewed the averages. So when these folks get on CNBC with me and say passive or indexing always outperforms active, it's just not true. They're using active portfolio managers, mutual funds, using the Morningstar 1, 2, 3, 4, 5-star rating system. But if you take out the 1 and 2 stars, the lowest rated ones, which you probably shouldn't be buying anyway, active outperforms. And nobody's telling that story. This is a ratio chart. When it's up at the top, that's when active managers have been outperforming passive. When it's down at the bottom where the arrows are, that's always been an inflection point where you should have been pushing money back to active managers. And we hit that inflection point about 18 months ago. Speak to valuations. The chart on the right is the median valuation in March of 2000, 31 times. The median valuation in March of last year was 17.3. Plenty of corporate profits. There are more high growth, high margin companies in the S&P 500 than in the history of it. By definition, valuation should be higher than the historic norms. This is something not many people are talking about. There's been a tectonic shift from tangible assets on corporate balance sheets to intangible assets, which you can't really put on the balance sheet. So what's an intangible asset? Well, Facebook has got 2.2 billion embedded users. What's it worth? It's worth a lot. You can't carry it on the balance sheet as an asset. Here, too, by definition, intangible assets should carry higher valuations than tangible assets. And if you scratch just about any professional in this business, they'll tell you the average PE since 1926 for the S&P is 16.5 times, and that's true. But if you take out the aberrational low PEs in the 70s and 80s that were driven by 22% money market interest rates and 15% inflation, and start with January 2nd of 1990 and get the S&P's price earnings ratio, January 2nd at 91, 92, 93 through January 2nd of this year, the average PE has been 23.85. I'm not telling you we're going to expand to 23.85, but at 14.4 times this year's estimate, if the estimate's right, stocks were not expensive, and we've had the rebound to validate that. PEs have not actually been that good a predictor of price direction. The green line is the S&P 500, and the big bars above the center line are high PEs, and you see what the market did. And below the center line are low PEs, and you saw the market come down. And the reason price earnings ratios may not be as good an indicator anymore is because of the way the new tax code was written. As relates to deductibility of debt, companies are going to be accelerating their depreciation and amortization as quickly as possible. That fundamentally shifts the argument about PE valuations of the market, because if companies are intentionally accelerating and depreciating non-cash items, it basically raises the price earnings ratio to higher than it really is. We think the market has transitioned from an interest rate driven secular bull market to an earnings-driven secular bull market. And that flip happened in mid-2015. And this is the return from 1938 through 09. The average return in an earnings-driven bull market is 13.1%. And I'm going to stop right there and see if the other folks on this call want to chime in.
All right. Well, first, very compelling argument. As I was talking to you before the show, I tend to share your secular bull market view, and I think we are in a cyclical bear market. I tell you what I'll do, if you don't mind, I'm going to grab the screen and show you a couple of charts.
Sure.
Get your opinion on these. Okay.
Perfect.
So, I'm going to first go back to 1998, because this, in my view, is the last time that we had a cyclical bear within a secular bull. And this was back in September, well, actually late August of 1998, where we broke down below some prior lows. We didn't have the volatility index. Actually, I think we did have the volatility index. I think it did shoot up very similar to what we saw this year. But you can see this reaction high, which went back about 14%. And then we went back down. We did double bottom before we started to break back out again. And if I go to the 1991 cyclical bear market, you can see the breakdown below the prior lows. The reaction high was about 7%. And we ended up going down a little bit below that earlier low in August before resuming that secular bull market. Now, I know you said earlier that, those couple of days that we had back in, I think it was on December 26th, and then again, maybe on January 3rd, where you saw more than 90% of the stocks moving higher on days that, obviously we saw some really nice action in the overall indices. Is that the only reason that you're saying that you don't believe we could go back and maybe at least retest those earlier lows, or are there other factors that you're considering as well?
Well, I did a conference call to our financial advisors, with Ned Davis, who I've known since the early 70s. And it's interesting because he referred to those two 90% upside days as breadth thrusts. I think that was lionized by another friend of mine, is deceased, Marty Zweig. And if you study the Lowry service, which I have used for 40 years, they will talk about, when you make a new low and that's followed by two 90% upside days within a 2-week period, it almost always means that was a major bottom. And I happen to agree with that. So I don't think you're going to get a retest of it.
Okay. Now, just to see if I think I have the current picture showing here as well. Okay, I can annotate this and update it for the move that we just recently saw. But currently in this particular rally in the cyclical bear market, and maybe it's over, as you said, maybe that was the end of it. We've currently rallied almost 14%. Is there anything to the downside that would then suggest to you that maybe it's going to be a little bit worse in the near term? I mean, I know the big picture, and I agree with you. I agree with the secular bull market view, and I do think a year from now, 2-3 years from now, we're going to be looking back at this kind of like we look at 2011, 2015, and so forth. I think it's just going to be in the rearview mirror. But is there something to the downside? I know you mentioned 2,500 on the S&P 500 earlier. Is there a point where you'd say, okay, maybe we are going to go down one more time?
As the way we measure the market's internal energy, the internal energy has been used up in that move from December 24th and into that peak that you're showing right there. Okay. So it would not surprise me in the very short run to see the market pull back. And the target zone I had on it, just like on the upside, we had a target zone from the December lows of 2,600 to 2,650. It overshot that last week on alleged favorable trade news out of China. But we stuck with our cautious on the near-term basis because of the market's internal energy not being there. So we think you could pull back to 2,500 to 2,550 and everything would be okay. Now, if there is favorable news coming out of China, the pullback's not going to be that deep. If you get the government restarted, that's probably going to be a step in the right direction as well. But as of right now, and I've been wrong in the past many times, when you make a call and take a stand, you're going to be wrong, and more often than you think. And the real trick for a successful investor is to be wrong quickly for a de minimis loss of capital. So I have no problem saying that was a bad call. But right now, we're cautious on a short-term trading basis. We think the pullback is not going to be all that big, and we think it's for buying.
Okay. There was a couple of questions. Looks like there were a couple questions in the chat room, so I'll just pass these along to you. But one of them was basically, why are you sure that the low is in? Will the market ignore the GDP hit that is looking inevitable due to the shutdown?
I still think the economy's strong, and yes, you're going to get it. But then you'll have all this pent-up demand when the government reopens, and as you know, it's not totally closed down. Anyway, no, the sequence that you saw was a selling climax followed by two 90% upside days. And it's almost 100% of the time when that sequence takes place, you've made a bottom, and it doesn't get retested.
Okay. I know, too, the volatility index shot up to about 37, and historically that's been a pretty good indication of the baby going out with the bathwater, kind of a bottom that normally gets set in stone. So, all right, another question. Does the political environment bother you at all? In other words, presidential election coming up in 2020, does that factor into your analysis of the market at all?
Not this time. Nobody knows who's going to be running against, Donald Trump. Mm-hmm. Unless they impeach him. So I think it's too far out there to analyze right now. Mm-hmm. And there's a long time between now and then.
Okay. All right. Well, I know you've only got a couple minutes here. I thought maybe what we'd do is we'd pull up the poll that we were running, and you can kind of give your thoughts. I know you said you're not too concerned about the government shutdown, and honestly, I think the market has already priced all that in. I'm not concerned about that as well. But we did mention a few different things that, what's the biggest threat to the U.S. stock market right now? And in the room right now, U.S.-China trade dispute is the number one. The number two would be from all of that selling that we saw in the fourth quarter, some of the technical breakdowns that a lot of the, as you mentioned, you were expecting the market to top around 2,600, 26.25. I was looking for the same thing. Erin was looking for the same thing. So you've got a lot of technical folks that are looking at the market saying, well, it's reached the level we thought, we're going to start selling. So the other that other comment, bearish technical conditions resulting from the Q4 meltdown, 34% of our viewers believe that is the biggest threat, the technical side of the market. Do you have any thoughts as to what's your biggest threat to the U.S. market right now?
I would say geopolitical.
Okay.
You can't predict what North Korea is going to do. Although I do find it very interesting that he hasn't shot off any more rockets since he and Trump met. Mm-hmm. I think the selling climax and what you're technically calling a bearish meltdown were people selling into a vacuum. I mean, I talked to a lot of portfolio managers on a daily basis. There was nobody around.
Yeah.
In mid-December. There was nobody to buy them. So it resulted in a selling climax, which is, you don't see a whole lot of them. You saw, in fact, Ned Davis pointed out the same thing you pointed out. In 1998, you saw one. Mm-hmm. And in 1957, you saw one.
Right. Well, one thing that's interesting, too, I'm a historian of the market, and I think I was mentioning to Erin last week that the period from October 27th at the close to January 18th at the close is the strongest period historically for the S&P 500 dating back to 1950. And I think last week we needed to close on the S&P 500 above 2658 in order to finish that period higher this year, and we did that. The S&P 500 closed at 2660 right around 2670, I think, versus that
2675.
Yep. So we were actually up in that period again this year, and that marked the 33rd time in the last 36 years that the S&P 500 closed up during that 2-month and 20-day period roughly. So my question, I guess I know you got to run, but my last question for you, do you pay any attention to the seasonal trends in the stock market?
I pay attention to everything I think will help me predict or forecast where the market's going to go, rather than using the January barometer. So goes January, so goes the year. Lucian Hooper, one of my mentors, longest contributing editor to Forbes, and worked at Thompson McKinnon, where I worked back in the early 70s. And he talked about the December low indicator, and it's real simple. He said if the Dow takes out its December low in the first quarter of the year, watch out. And that's exactly what happened in 2018, and that's one of the reasons 2018 was such a tough year. And with that,
okay,
I'll turn the call back over to y'all.
All right, appreciate it. Thank you for stopping by, Jeff. Always a pleasure to have you on the show.
My pleasure.
All right.
Absolutely.
Yeah. Well, we could have talked a little bit more, obviously, about the January effect, because I literally just did a presentation yesterday. That would have been
exactly
to get his thoughts on it. But I mentioned yesterday that Mark Halbert of Halbert Financial Digest just wrote an article about the January effect and the fact that, I don't know, kind of saying that it was hogwash. And I would have loved to have had him sit in on my presentation yesterday and tell me that it was hogwash, because I don't believe it's hogwash at all. Like anything else, it's not going to work all the time. That's not the purpose of it. The purpose of it is to give you better odds of what's likely to happen in the market. I thought it was a pretty compelling argument, but we won't get back into that. If you weren't in for that yesterday and you're interested in looking at what happens in January and then looking at the subsequent 11 months, go back and look at yesterday's Market Watchers Live. You can get the recording on YouTube and check it out, because I think it was pretty compelling.
Yes, absolutely. I think I need to as well.
You might want to. You never know.
Yeah.
Anyway,
No, I mean, for this one, you know what? I didn't think that. I don't think the U.S.-China thing is a threat. I suspect it's going to be resolved in some way, shape, or form to the positive side. So I don't think it's a threat. And I also think a lot of that's probably baked in to what's going on right now. We've been doing this for months, this trade negotiations, months. Yeah. So I'm not really of that mind, but I think you can guess which one I am behind, which is the bearish technical conditions. I mean, that's really what I pay the most attention to anyway.
Yeah, it would be hard for me to argue. I agree with everybody answering the poll that I think those two are the top two, and I have a problem going with one versus the other. I mean, obviously I'm technical oriented, but I think the U.S.-China trade dispute, I think the first quarter, some of the initial shock was built in with the selling that took place in the fourth quarter. But if it continues going out, China's growth we saw the lowest level in many, many years just recently. And eventually that is going to spill over into many other markets. So I think that the U.S.-China trade dispute, if it keeps going on, and this drags months and months rather than just, it already has been dragging on for months and months.
Exactly.
If that continues through 2019, then, I think we could have some more problems in the major indices. We'll see.
Yep.
All right, let's keep moving on, though. We're going to get into the economic news that was out this morning. We did have the FHFA house price index out for December. That rose 0.4% versus the anticipated 0.3%. And the market reaction, if we take a look at the bond market, we'll take a look at the 10-year Treasury yield. You can see that we did move higher earlier. So that strength, I think, did show a little bit in the early hours of trading, but we backed off of it. And now, even though we are up two basis points, we're up a lot more earlier. I'm watching this 10-year Treasury yield because you can see that we topped 2 days ago on the 10-year Treasury yield, and these filled candles, we didn't really have many filled candles on the way up. It's telling me that the yield is moving lower from the open to the close, which means that money is rotating into Treasuries from the open to the close, and that is more defensive oriented. And in the short term, that can have a very negative impact on U.S. equities. So I don't like what I'm seeing here in the 10-year Treasury yield in the short term, but we haven't completely broken down. I think if we go back down below about 272 on the 10-year Treasury yield, that'll start to look more like it's rolling over. And I think in the short term, that could really hurt the S&P 500, all of our major indices here in the U.S. All right, let's take a look at some of the earnings news, because earnings, as I've said frequently of late, they're going to be picking up, and they are picking up. We've got IBM. IBM came out yesterday after the bell. Really strong report. When you take a look at the numbers, IBM did beat on the bottom line, 487 versus 481. They missed on the revenues, though, but they guided their fiscal year 19 earnings per share higher. We'll take a look at that chart in just a moment. Capital One, really disappointing report there. TD Ameritrade, Procter & Gamble, Comcast, all pretty good. Abbott matched. And then United Technologies really had a strong report of what they did in the prior quarter. Unfortunately, as I mentioned earlier, they guided their fiscal year 19 revenues lower, and I think that's why the stock is not seeing continuing movement to the upside after the gap. Well, let's take a look at some of these charts and see what's going on here. You can see first, this is IBM. IBM had gapped up earlier. Let me get an update because I don't think this is current. No, it's pretty close. We did get up to 135, but if you notice, you see the gap down back in October. I can annotate this, and I think it might be a little clearer. I think IBM went right back to where I would have expected it to go to after a strong report like this. Bottom here, you can see a double bottom at about 135, gap down to about 134, big volume selling, a lot of selling from 134 down to about 113. And then we put in a bottom in December. We've rallied back off of it. Nice report, so we got a gap up, but so far we're failing right where I would expect us to fail. So I'm not ready to say that IBM has righted the ship just yet. I think this is a stock that we want to keep an eye on. Great volume. If it closes above 135, I think it'll start to look a lot better technically. In the meantime, I think it's probably going to pull back maybe to the 125 area, and then we see what happens from there. Next up is Capital One. Let me pull up Capital One Financial. This report was not good. They missed on their top line. They missed on their bottom line by a mile. The stock gapped down. You can see it had been trading lower quite a bit here. As its industry group kept moving up, putting in higher highs back in September, you can see that Capital One actually put in a lower high. And throughout the last year, you can see it's just been a steady underperformance by Capital One relative to its peer group. And it came out in the earnings report today. I mean, this is why I don't like buying stocks that are performing like this against their peers. Why would you want to do that? If the money going into the group is being allocated elsewhere and not going into Capital One, that should be telling you something. And what it's telling you is what we saw in the fundamental report today. Not a good number at all. Ameritrade, AMTD, reported its earnings, and they beat on the top line, beat on the bottom line. Stock gapped up, but so far failing. I don't like that bearish engulfing candle. We had a breakout at the earlier, early in the day. We've reversed off of it. I think this probably, unless we get a strong finish today, I would expect we're going to see probably $52 on AMTD. Procter & Gamble. Procter & Gamble beat on the top line, beat on the bottom line. You can see moving up, trying to make that breakout, left that tail above that resistance area, though, and pulling back. So right now, I don't like this candle. If it finishes like this, I would expect we'll go back and maybe test at least $92 and maybe all the way down to fill that gap, which would be down closer to $90, 90 and change. Comcast beat on the top line and the bottom. You can see also moving higher earlier, but like so many other stocks, well off the earlier highs, coming back down, unable to get through that 50-day moving average. This is a stock that's doing more sideways than anything over the past few months. So I just don't see any compelling reason to jump in at this point. Abbott matched on the bottom line, missed on the top line. They guided their earnings per share lower. Fortunately, the stock is in the pharma group, which I think maybe will get a little bit of a pass, being more defensive oriented, but the stock is still down 2.8%, sideways consolidating. I would be a buyer of the stock down around 65, seller at 74 until something changes on the chart. And then United Technologies, UTX, you can see here was the gap up. Stock got up to 119 and change earlier today. It is now at 115 and change, though. And as I mentioned, they did guide their fiscal year 19 revenues lower. So they had a huge beat on the top line, huge beat on the bottom line, got a nice reaction. But if the revenues are going to go lower in the future, I think maybe some traders are pausing a bit after that earlier push to the upside. A couple of charts I want to show you today before we get into the upgrades and downgrades. One is the XLY versus the XLP. Now, this is going back over the last 15 years or so, but you can see after a huge push higher in 2018, we have been putting in lower lows and lower highs, and it looks like it's starting to roll back over again. If that continues, I could see this moving back somewhere between 1.7 and 1.8. We're currently at 2. Now, if that were to occur, what essentially is happening is money is rotating more toward consumer staples, then consumer discretionary. That is the type of scenario you see when the market is weak. You can see how this came down from that early October high, and yet during the entire bull market, for the most part, it's been going up because money's been rotating more toward discretionary. I think this is a little bit problematic here with this beginning to roll back over. I also saw it, let me pull it. I don't know if I need 15 years, but I think if we take a look at the NDX, the NASDAQ 100, and compare it to the S&P 500, you can see the same thing since probably the middle part of the third quarter. We've been moving lower. And anytime that happens, that can be a little bit difficult for the market to absorb because, again, money is rotating away from the more aggressive NASDAQ 100. Finally, if I pull up the transports versus the utilities, you can see the same thing. You see this pattern of lower lows and lower highs? It's telling us that more and more money is rotating away from the transports and into the utilities. We saw that back in 2015, 2016. The market struggled when we were going through that period. Now, eventually we broke out of it and led to some really solid action in the S&P 500. You look back to the bottom occurred right when the stock market bottomed. This is a pretty good indicator. And currently, you can see that the transports relative to utilities is rolling over again. And I wrote about this in my blog yesterday about the transports. I thought the transports could hold some clues about the market. Here you can see the low 9,800 to 10,000. Here you got up to about got down to about 10,200. Well, here we rose all the way back up, tested 10,000. You can see us rolling back over. We want to watch these rising 20-day EMAs. Why? Because if we break down on the daily chart, then we've got to go back to the weekly chart. And on the weekly chart, we're already in trouble. Look at all of these bottoms around 10,000 on the transports. So when we came up and we hit 10,000, we're hitting price resistance and now also that declining 20-week moving average. And you can see what's happening. Sellers are regaining control of the market here at this level. So there's a lot going on. But, you know, when you look at the daily charts, you get excited about the market. But if we don't hold on to some key support levels on the daily chart, I think you have to refer back to those longer term big picture charts. And I think the selling could really accelerate. So I think you want to be careful here. Talked about a few weeks ago that we would have a nice rally. That would be an opportunity maybe to check out of the market for a while, see what's going on. I think we have hit that level. I thought that we were getting very close to a bear market top. I think that was my article headline maybe on Friday of last week, maybe Thursday. I think it's here now. And now the question is, can the bulls contain the selling to the downside? Because the bears are going to throw the kitchen sink at them right now, in my opinion. All right, we got upgrades, downgrades. We didn't forget about them. We were just kind of mixing up our schedule up a little bit. But Erin, what do you have for upgrades, downgrades today?
All right, let's go ahead and take a look. The first one I'm actually, before I get to it, Capital One today actually was downgraded. So it was interesting you were talking about it. And some of the people in the chat room were also saying that, you know, you've got problems with credit defaults right now. So that could be interesting to see where that goes as we see that going forward. But all right, let's go ahead though and look at what we have here. Logitech is my first one that we're going to look at. This one was upgraded by two agencies actually today, JP Morgan and Maxim Group. Interestingly though, JP Morgan moved it from neutral into overweight, and then Maxim said it moved it from a sell to a hold. So one is all in and the other one is neutral. So interesting look. I guess they reported really great sales on their headsets and all the various equipment that gamers use for Fortnite, which I guess is killing it out there in the gaming area. I have no idea what's going on with that. I have two girls and we never did any of that. So, but I guess that's doing quite well. The chart looks pretty good. You've got the PMO buy signal. You know, we got warning really that things were going to go well, and it continued to rise. Even as we were moving sideways here and consolidating, we still were seeing the PMO rise strongly. It didn't even decelerate really by much. Now you see the OBV, granted, probably from this positive volume we're getting right now, but it is moved to a level that's higher than we've seen since October. So I think that's also positive. What I would watch for, We beat this level of resistance, which I had lined up with this low back here in April, but I think you can also make a case for the $36 area. It's near the gap right here that it was closed earlier, but it's near the gap. It's also picking up these lows from April and May, and it also lands there with that February low as well. So if we can get past that area, that $36 level, I think you certainly have an opportunity to see it run. I'd be a little concerned right now with all the interest in the news headlines. Might need a pullback before that. All right, next one that was upgraded, Lamb Weston by Stifel from a hold to a buy. The things that I find on this chart that I'd like to point out, first of all, a PMO buy signal just came in, and the PMO is already starting to curl upward. I think it's an interesting time for an upgrade. It's the kind of chart I want to see. The only thing I would be a little concerned about here, we did beat out resistance, managed to break out, but now we have declining tops trend line. So we want to get past that so that we can get out of this declining trend that we have been in since the middle of November. So I'd like to see that breakout occur. If we get the breakout, consumer staples is a defensive area. I'm still looking for the market to move lower. So could be a good play. All right, so let's look at a couple downgrades. Lowe's was downgraded today by Loop Capital from a buy to a hold. We already had warning things were going the wrong way as the PMO was already turning down. You can see that declining tops trend line, this reminds me of that last chart we looked at. It came up for the third time to try and get above that declining trend. Wasn't able to do that. So really the good news at this point would have to be that it's holding that $90 level, which matches right about here for that October low, and then the top of this consolidation range. I am looking for a break to the downside. You've got a PMO top and that sell signal is almost ready to be activated there. All right, another downgrade today. Mylan was downgraded by UBS from a buy to a neutral. And there you go. We've been in a consolidation range. We're near the bottom of that range. Normally, I like to see trading ranges with price near the bottom because that's usually an opportunity maybe to get back up to the top of the range. However, we have the PMO now turning down. So at first, this looked pretty good, right? It was consolidating sideways and the PMO was continuing to run. But as soon as we started to break down, back here at that 28.25 levels, you can see that the PMO has started to pull back and we're getting a top now below the zero line. So I don't like to see that. I would be looking for a drop if this support area is broken at 28, which I suspect it will be based on the PMO. Then I'd be looking for a down move down to that $26 range. All right, 2 more to go. Toll Brothers was downgraded today from a buy to a neutral. And, I noticed that there were a few other home builders out there that came in, a couple with a couple upgrades, but also like DR Horton came in with an upgrade. But we have Toll Brothers and, I'm sorry I didn't write it down, but I know there were 2 other smaller groups that are in this home construction area. And right now we are on some very, very important support at about $34 for Toll Brothers. We have the PMO top in overbought territory, getting ready for the sell signal. I would not expect this area of support to hold. I would be looking for a drop below that and a target around $30, possibly all the way down to $29 or $28. All right, Tesla is our last downgrade. RBC Capital downgraded Tesla today from a sector perform to an underperform. Not looking too good today on that downgrade. We already could see there were some problems as we had the first decline. Of course, that was a huge move to the downside that we saw last week. And now we're flirting with another move down to support. And I think this is just right here, the 270 level. I think that's a wishful thinking area of support. It does match up back here with those April and May lows. But I would, based on this PMO and now seeing it move into negative territory. And you can tell in the thumbnail, it has dropped below the previous low that we had. So I don't like to see that. Of course, the scooter has fallen out of the sky. I would look for some more downside on Tesla. If things go well, it'll be able to stop itself up at 270. Maybe that'll be the area for some consolidation or a pause, but I'm looking for Tesla to fall even lower to that 250 level. And that's all the upgrades and downgrades I had. Some of the ones I did not talk about or look at, DR Horton, as I mentioned earlier, was upgraded, International Paper, Teva Pharmaceuticals, Vips Shop, Walmart, all of them were upgraded today. And some of the other downgrades, Delphi Technologies, Meritor, Pfizer, Texas Roadhouse, Williams-Sonoma, Merck, and as I mentioned earlier, Capital One. So let's go ahead. It's time to move right on into that 10 and 10. Sort of interesting to do the schedule slightly different.
Yeah, I thought it was good, though. I know otherwise we'd have had to cut off Jeff's presentation quite a bit. We wanted to hear from him, get his thoughts. I know he's had some rather bullish calls, not just here on Market Watchers Live, but also on CNBC. So I wanted to see what maybe the December swoon, whether or not that had changed his forecast. Obviously, it did not. But we are going to get into the 10 and 10. So I'm going to go ahead and start with AGNC.
Yep, let's do it.
All right, first thing I did that you notice maybe is a little bit different here is you're going to see these little volume bars. If you go down here, just a quick little tip, but if you go under the underlays, you can find the volume by price down here. And essentially what it does is it just gives you a different way of looking at where some key overhead resistance or some key support might lie on a chart. So anytime a stock closes in a range that is designated by these bars, you add the volume. So for instance, you can see all of these different days where AGNC closed between 18 and 1810 or in that neighborhood. That adds the volume, and you can see the green is the up volume, the red's the down volume. But just by putting up, bringing up that overlay, you can see that there was definitely this is an area 18 to 1810 that we should be paying attention to because of all the volume that has traded in this area. And if you look, the last 3 or 4 times we've gotten up above $18, we have failed in this range. So clearly from a resistance standpoint, we need to get a breakout there on AGNC. Haven't gotten it yet. I would respect that. To the downside, look at these 20-day tests. So the stock's got a PPO above the center line. Momentum is definitely on the bullish side at this point, but we haven't been able to negotiate this resistance area. So the first thing I'd want to see is a close over 1810. If we can get that, you're not going to see nearly as much overhead supply. I think that would probably lead you up to test this double top closer to the 1850 area. To the downside, I'd be careful if you lose the 20-day moving average, because then you're not looking at any major support until you get back down here around 1740, 1750.
All righty. The most popular request in the chat room would be Newmont Mining, NEM.
Yeah, I don't like the big volume gap down. I mean, the rally was nice, but it was pretty shallow. Took a long time. There's a lot of ups and downs going through here, but it definitely had an uptrend in play. I don't like this gap down on heavy volume. Now, it is recovering, so we're going to get a test. And I think we'll probably continue to rise until we get up into this area. And I have just highlighted the open from this day. You can see all the heavy volume, almost 30 million shares. And you look back, that swamps any other day. So when you get that kind of selling that starts at 32.80 or so, works its way all the way down below $31. That day, though, there were some buyers intraday that took it up to about 33.50. So I think probably somewhere around 32.85, 32.90, all the way up to 33.50 is where you're going to see selling kick back in. And notice the declining 20-day is right there in the middle at 33.13. So I think there's some overhead resistance that Newmont Mining is going to have to deal with. I would not be a fan of it at this level.
Okay. Let's see. The next one was also quite popular. And for our friends in Canada, we have CCL Industries. So that will be CCL/B.TO. Sorry about that.
Right.
CCL/B.TO.
Yeah, I tried to guess.
Fooled you on that B.
Yes, you did. You got me. All right, let's see. Big volume gap down here. So these are reaction highs coming up here, still in a downtrend. So overall, I'm going to look at it. I'm not going to be too excited about it. Short term, I do like the fact it's holding the 20-day, and we have gotten that golden cross. So I think the two overhead areas, if the uptrend continues, I think we're going to have maybe a little battle that'll start at around 55.5 and maybe carry us all the way up to about 56.5, which is gap resistance. Let's see if we can get through there. I would be a seller of this particular stock in the 55.5 to 56.5 range until I can see us clear gap resistance. The volume here, over 2 million shares, is heavier than anything on the chart. So when I see that putting in new lows, we got to get back up and take out that gap resistance. Until then, I think this is a sell.
Okay, let's see. From Consumer Discretionary, O'Reilly Automotive, ORLY.
All right. I actually think this one looks pretty good. I like the sideways consolidation. You can see them move up, pull back, new high, pull back. I think we're just consolidating here. And given what the market has done, this is actually pretty good action. We really didn't see a whole lot of selling in this stock relative to what we saw in the overall market. So I would just play the trading range for now. I think it's a buy down at 327 or so, 325. And I think it's a sell at 360 until it breaks one way or the other. My guess is we're going to break out before we break down.
All right, perfect. Next one up, actually, it was our first request today. ServiceNow, NOW.
I think the resistance here is pretty obvious, coming across between 190 and 195. So I want to see that level taken out. And if you can't see it, then maybe this will help. But here you can see the top in October, the high in November, almost there beginning of December. Just tested it here in January. We need to get through about 193 on a closing basis before I'm going to be too excited. Now, we have seen the PPO do this before, breaking above the center line. Everything looks good. Volume trends here good. And then all of a sudden, we couldn't hold the 20-day and back down we go. So now here we come again, moving up. Volume trends just kind of average this time. PPO looks good. Trying to hold that 20-day. If we fail, I think we probably head back down toward the 150 to 160 area to test those recent lows. So I'm not really seeing too much here on this chart, just sideways consolidation. I'd either wait on the breakout or until I got to a closer area of support. Now, if you're trading this as an uptrend and you want to buy it on the 20-day, that's fine. I would just keep I'd keep my stop really tight. If I closed below this level or maybe even intraday move down a couple dollars, I'd probably move back to the sidelines.
Okay. Next one up, I talked a little bit about it. You talk about it a lot. The Home Construction ETF ITB.
Yeah, home construction has just been one of those things that's all over the place. I like this 20-day test, but the market needs to hold. It's going to be one of those situations where if the market goes down, it's going to be very difficult for areas of the market to move higher. You can see that the home builders were trying to straighten out and strengthen back in November, but when the market went down in December, it went down with it. So I think this is going to be a key short-term area here at the 20-day moving average. So I would simply just mark that. And if we hold it, I think that's a great thing. What I want to do is hold it and break to a new high, get back through about 33.60, 33.70. If we can do that, I think this is bullish. Otherwise, unfortunately, if it fails, I think the overall market, if it's weak, could simply bring this one down, just like about every other group in the market.
Okay. Let's see. Halliburton, HAL.
Yeah, they just reported. And the results I didn't think were that great. The reaction high here, though, off of this low, is at a key area. I'm going to say between 32 and 33, closer maybe to 33. I'd like to see us clear that level. So there was the high back in. So you see the selling coming down, big volume, little reaction high at 32.80, come back down to a new low, reaction high 32.80, go all the way down to the new low. Look at the volume on the selling. Now we come back up on lesser volume and we're up close to the area where we failed twice. So I would just be a seller at 32.80. Got a nice uptrend, trying to get this bullish golden cross here. Whether or not we get it, I don't know. But to the downside, I would also watch the 30 area, because if you lose 30, you're losing your 20-day moving average plus all of these recent lows. So this is a trading range I think we're in on Halliburton for a bit. Let's see which way we break.
All right, from the life insurance industry, eHealth, which is EHTH. EHTH.
All right, this is one I'm going to give you later in the show, so you get to look at it as well. But eHealth, I think, looks really, really good. It's just overbought. So that's the biggest thing that scares me here, is just trying to manage my risk on the trade. So when I talk about overbought, I mean, well, you see the chart's been going straight up. But anytime I get an RSI that is in that 70, 80 zone, we're up to 79 now. I rarely will buy a stock with an RSI at this level. I mean, look here, big move up. Look at the volume coming in. Everything looks pretty similar here. But look at what happened. It took the stock 3 months to get back through that high. So if you had been trading, you didn't really lose a whole lot. Maybe in this area you would have lost some. But it's also tying up capital as a trader. That's very frustrating. So I don't want to get in and have this thing begin to consolidate and have to sit there and hold it for a while. I'd be looking maybe for a pullback to test that rising 20-day. I think that would be a great entry.
All right. Let's see. Next one I have, our only real estate request, Landmark Infrastructure, LMRK.
All right. LMRK, a beautiful move up. I mean, this is a nice little flag. Look at the volume there coming in on this move, breaking out above the prior highs. I'm not sure what's happened to the stock, but technically it looks pretty good. One negative or one downside is that when we're not in these kinds of days, the average volume tends to be well under 100,000 shares. So I'd be a little concerned about just the illiquidity. But let me just draw this in. Here is your flag pole. Now you can call this a flag. You could call it, maybe like a symmetrical triangle, something like that. Pennant. I mean, a lot of different names you can call it, whatever you want. But the point is, you've got an uptrend followed by consolidation. That normally results in another breakout. Not always, but you want to see heavy volume pick up. Close above 15 with increasing volume, to me, would suggest another leg higher.
Okay. And our final one is going to be Intuitive Surgical, ISRG.
Yeah, I think they might report coming up today or tomorrow. I have to go back and look, but I think they're on my list for big companies I want to watch that are reporting this week. And you can see overhead resistance is pretty critical around 550. A lot of tops coming in this 540 to 550 area. So the fact that we got up there, couldn't get through, leads me to believe maybe we're going to get a 20-day test. But going into earnings, anything is possible. So I would just, from a technical perspective, watch 540, 550 resistance, watch this rising 20-day. Nice move up here on some pretty good volume. So I think the stock's looking pretty good, but I still wouldn't buy it heading into an earnings report.
All right. That does complete the 10 and 10. And here are the symbols that we did look at. If you want to go get those charts for your own chart list or just review them more slowly, you can get to them by going to the articles or blogs tab and click on the Market Watchers Live blog. And there you'll find the link at the very top of the page. Also, in every Market Watchers Live recap that I write, you will also find the link to that chart list. All right, time for our final market update. Let's see what's been going on in the market while we have been chatting. All right, here we go. Really interesting market action, I would have to say today. We had that big gap on the open for the industrials, and you can see for many of these large cap indexes. And then we proceeded to fall back into negative territory. Now, the Dow has managed to get itself back up into the positive territory at this point, but the S&P and NASDAQ aren't quite there yet, but they are trying to make a comeback. We can see the mid caps also similar situation, as well as the Russell 2000. All of these are trying to make a comeback here after an intraday low to get back positive. But like I said, right now, so far, the Dow is the only one positive. You can see the TSX is down almost 1/3%, similar fashion for the market action as well in Canada. We can see that Treasury yields, started up much higher on the day and have pulled back, but they are still up, currently reading 2.748%. The VIX is still high, I would have to say, sitting just above 21, but it has come back down from a reading of almost of a little bit above 22. So that I think is interesting, especially coming in as we started to see the market move lower. All right, UUP, the dollar is down right now. You can see the consolidation that's been going on over the past couple days, but now we're making a move to test the low back here from Thursday. And, it looks like we might make that move. Now, gold, on the other hand, was also down on the day with a big gap down, but it has managed to get almost into positive territory. It did, but it's now dropped. Currently, GLD is at 121.43. USO oil is down currently. Also looks like it might have hit its intraday low and is moving higher, but it is still down over 1.25%. TLT is up slightly, reading 120.43. And that's all I have for my market update. What you got for us, Tom?
All right, I was just going to bring up the sector summary. Just wanted to point out a couple things. First of all, energy. If you look at the scooters, energy is the lowest scooter at 4.7. But the second lowest on this list is communication services. So this is the sector that houses the internet group. But what I wanted to point out is we've talked a lot about on the weekly charts things being pretty bearish, but on the daily charts things being pretty bullish. What you want to look for if you're on the bear side is you want to start to see the short-term chart breaking down. And when I went through the different sectors and looked at the different sector charts, the XLC, which has that scooter rank of 11, so it's one of the weakest sectors, is threatening to break now below its 20-day moving average. In an uptrend, we should see this continue. If you go back and you look at these, over the fourth quarter, each time we've gotten above the 20-day and we've rolled over, we couldn't get back through the 20, and it led to a lot of selling. So I'm just pointing it out that this is the first of the key sectors that potentially could be losing a major short-term support level. Not good action. The other thing, if we go back and look at that sector summary, two sectors leading today that are green: consumer staples and utilities. Real estate also near the top. So not looking particularly good. And with selling, you do expect defensive groups to be leading, but the fact that they're green, they're higher, while other areas of the market are selling off, I'm not viewing this very bullishly right now.
All right.
Okay, so we are going to go into the final segment, and this is Spotlight Stocks. And what we're going to do today is I'm going to give Erin some stocks that were in the news this morning, mostly earnings related, but not necessarily last quarter, but could also be some stocks maybe warned, maybe raising estimates, lowering estimates, whatever. But let's start with ConMed, CNMD. They reported earnings, but then they raised fiscal year 19 revenues and earnings per share. What are you seeing with ConMed?
All right. I like the chart. Of course, I don't, like we always talk about, I wouldn't want to chase. But I'm looking at these levels right now. We beat out that overhead resistance, and now we're looking at it as far as a decision point perspective. We are in technically a bear market configuration with the 50 below the 200. But the 50-day is now starting to rise, of course, because price got above it. And now we're seeing the 20 just about reaching that 50-day EMA. If I get a crossover here, that would be an intermediate term trend model buy signal. Now, in the shorter term, we're already seeing the PMO buy signal that came in, and now we are now hitting positive territory with the PMO. I don't see any weakness coming in here. A lot of interest, obviously, with that volume. As far as overhead resistance goes, that's kind of like, I guess you could put some here at about 75, 76 at these tops that we had back here in the summer, June and July. Kind of matches up with the low we saw back here in August, as well as resistance back here in October. We're almost there, and everything's looking pretty nice on this chart. At this point, it's in the healthcare, which I like because I'm a bear right now. So I would be looking for it to move higher, but this is an awfully large bar here. I would be looking for maybe a pullback, bring it back down to that $71, $70 range. And then you've got that potential to go on to the upside, pass up that resistance level. And this one could actually get back up to September highs, 82.50.
All right, let's move on to Comerica, CMA. They increased their quarterly cash dividend today from 60 cents to 67 cents, and they approved up to 15 million share repurchase. What do you think on CMA?
Interesting. Well, this one was already shaping up and looking quite nice. And we have, let me go ahead and annotate. It's a little easier to talk about it. All right, so we have this area right here. You can see that was support back here in October and November, broke down, had a V bottom. Typically, I don't like to see V bottoms. They generally break down, but we managed to get back up above what was support and turn to resistance. We now have a PMO in positive territory. OBV, you can see the volume has been flowing on this rally, which is always nice to see. Scooter is improving. So I like this chart. You've got the 20, 50-day crossover really on tap here. So there's another intermediate term trend model buy signal lining up. Overhead resistance in the short term, look at these tops back here from October and November. After that, I would start looking at the lows down here that we had earlier in the year, and you could almost bring this up. I think that would be even more valid because that takes into account the lows we had back here. So I would be looking at that $89, $90 range if we can get, of course, above that 85. We do have a 50 well below the 200. So, of course, like I said, that puts it in a bear market configuration. And when I see that, I don't always expect those bullish outcomes. But we did get the breakout, so I'm liking that.
All right. Next up is PUMP, Pump. This is Pro Petro Holding Corp. They raised their Q4 revenue guidance today. What do you think?
All these V bottoms, I really don't like those. What do you think of V bottoms? Do you like those? We don't talk about them much. So.
Not much. It just depends. I mean, like if there's a positive divergence on that final bottom, then I'm fine with it. I don't need to see it go back and retest. But yeah, ordinarily, I don't like the V bottom. I don't like it coming straight back up. I assume it's going to fail at resistance.
Yep, I think so too. All right, so we have the PMO buy signal here, getting ready to move into positive territory, so that's good. We have managed to continue that momentum swing as we continue higher. We had a pullback yesterday, but then let's face it, the whole market had a bit of a pullback. So not surprising to see. Right now, 200-day EMA, $16 is your overhead resistance. I see it beating that out. The reason being is the PMO is still very healthy and almost accelerating just a tiny bit. You need some glasses maybe to see that, but I do think that we're seeing a very positive PMO. So where is our overhead resistance? Well, right now, like I said, $16, 200-day EMA. Would love to see it break that level, and then I would have far more confidence if we got that 20, 50-day EMA crossover buy signal. So I'm looking at, let's see, next level if we can get over this 16 would be that 1750. It comes up here to those tops, the low we had back here in April and May. And then of course, the next level is pretty easy to see, the top that we had in November. So I'm watching this. If we get that break above the 200-day EMA, I think we're going to see it run a bit higher.
Okay. Next up is PTC Therapeutics, PTCT. They announced a $200 million common stock offering, and as a trader on the long side, I hate seeing these because it normally doesn't mean very good things on the chart.
Well, definitely have to say there aren't very many good things on this chart. So let's see. First thing I'm noticing, of course, is very short term. This low we had in December, we are sitting on it. We got the big gap down, but I really wouldn't be looking for it to hold. And the reason being PMO turned over. Now we have a sell signal. It's back in negative territory. Look at the scooter, pretty much falling down into the basement past lows we've seen back in November. If we can get if this turns out to be an island, you know, we could get the fill of this gap that we had here, but I think it's more of a breakaway to the downside. So I'm not expecting this level to hold. If it doesn't hold, there are a couple levels of support after that I would put based on what we're seeing here, those lows. $25, $22.50 would be after that. So I don't know. I might have this on my shorting list.
All right. Next up, I told you you're going to get a chance to talk about this one, eHealth, EHTH. They raised their Q4 and fiscal year 19 revenues, but then came out and announced a secondary offering of 2 million shares. It's pretty slick to come out and raise guidance and then announce a secondary offering. Maybe they're offsetting one another, but anyhow, what do you think of EHTH?
All right. Well, the first thing that popped out to me, let me get this organized here a little bit more. Parabolic move. You know, I tend to stay away from them. You're most likely going to see a big time breakdown from these as profit taking starts happening. And I would look for the downside. You know, typically it goes to the last, you know, the last basing pattern, which would be probably back here at that 3250 level, but it could even move all the way back down here if this is a true parabolic. Looking at the PMO, overbought, very overbought. It is still accelerating higher, but of course on a parabolic move, I would expect to see that. You've got a nice scooter rank here. And again, I would expect to see that based on a big move like this. But I would say I wouldn't be getting in. And if I were in based on this parabolic, I would want to set a stop, probably, well, a trailing stop. That's usually what I use for parabolics. And that way I can not end up in the melee and bloodbath that generally happens after a parabolic fails. So that would be my opinion there. It looks good, but I don't know how much longer it's going to be that way.
Do you trade parabolics in both directions? I mean, do you consider a parabolic to the downside? I mean, think about that PCG, that electric, the utility with all the fires and the liability and all. I mean, do you consider that to be a parabolic to the downside or only to the upside?
I got the wrong symbol there. What is the symbol? Just PG?
I think it's PCG.
PCG. Okay, there we go. All right. Yeah, with parabolics, if I don't trade them, what happens is I'll get into a stock and it'll go parabolic, which of course we all love to be a part of. Doesn't always happen. When I start to see it happening, then that's when I set that stop. I don't trade them because I never know when they're going to break down. To the upside if it was going to, you know, lower or to the downside. You know, I just don't want to get in those when they've hit that area where if you can visually see a parabolic, then I wouldn't get in it. And if I were in it, like I said, set those trailing stops and you should protect yourself.
Yeah, I think too, some of the movement to the upside obviously is euphoric, and it can be a good thing longer term for the stock, but short term I agree with you. When they're going straight up like that, they need some consolidation and pullbacks. In the case of the PCG that we just looked at, I mean, that stock going down, they're going down because they could have going concern issues. I would not be jumping in expecting kind of a big rally out of that stock. All right, the next one up is QUOT. They lowered their Q4 revenue guidance. QUOT. What do you think?
All right, let's look at it. Consumer discretionary, it hasn't been suffering too much. Let's see here. Yeah, it's a pretty ugly chart, obviously, just from looking at it right away. You know, you have, I would say, kind of a zone here that was support at 1025. Let me make that a little lighter so I can see better. There we go. Broke down below that. Look at your volume bar here. It's higher than the price bar. I mean, it is moving lower at a very fast rate. You know, the unfortunate thing is that had you been in it and you were buying off of that PMO buy signal, you know, we got a price shock on that day there. And that did manage to at least get the PMO to flatten. But I have to say, in terms of PMO trading, this you probably wouldn't have been saved as far as this low coming in. You know, I don't like it. That looks like a total breakaway gap to the downside. We don't even have support showing for the year. the daily chart for the year. So I'll actually move this to a weekly just to get a better idea of support levels. Wow. Yeah. It could certainly find its way back down here to those 2016 lows. Right now, I think your hope, if you are in it and you've still managed to hold on to it because of, sort of that fake out, we're right on that support level. So, it could bounce back here. But look at the weekly PMO even. It started to accelerate lower. I don't like it. I suppose if you wanted to try it as a short play, but I think there are other ones you could probably do better on. But I don't know.
Okay.
Interesting one.
Well, let's take a look at ASML. ASML, which is ASML Holding. Now, this is a semiconductor, and many of these semiconductors have gotten hit pretty hard. They missed on their quarterly revenues and their quarterly EPS, and they guided Q1 revenues lower due to a supplier fire. So looking at this stock, I mean, it's actually up today with some pretty bad news. I don't know. I wonder if a lot of the bad stuff's already built into some of these semi stocks. What do you think?
Yeah, I have to agree with you. And honestly, let me see if I can get my annotation tool. I think there might even be a possible, a little bit complex, but you could make a case for a head and shoulders, a reverse head and shoulders, head being these tops, this shoulder. We can see this makes a shoulder over here, and now we're just sitting right there on the neckline. Let's go ahead and make this look right. So let's go that way. So the neckline, I'd say, is right about here at 165, maybe a little bit lower. And so that would be, if we get the breakout to the upside, I mean, everything technically on the chart looks good. I don't like hearing news like you just passed on to us. So 50 being well below the 200, there's a possibility here, but I certainly wouldn't be jumping in on the possibility of it moving higher.
I mean, sometimes we get the, people sell on the rumor and then they buy on the news. So, I mean, the stock's been going down for the last 4 or 5 months. So a lot of this could be priced in, and what the market could be doing is simply exercising a little bit of relief. Now that the news is out, I kind of agree. I think if it breaks out above those recent highs, it would be an interesting type of play.
Yeah, and it's in a nice rising trend channel as well. So, yeah, I would say a lot of that must be baked in. They must have known about it.
Oh, I'm sure they knew. That's not a question in my mind. All right, we got TEL. TEL, they beat by a penny, but then they lowered their Q2 revenues and EPS, and they lowered their fiscal year 19 revenue and EPS. So they beat by a penny and then basically dropped a bomb on the market. What do you think of TEL?
Interesting. All right, well, let's look here. So, we had broken out. We had a nice rally here, broke out above $80, and then the breakout failed. And again, 50 well below the 200. I always am a little bit cautious when I get into stocks where I see that, because a lot of times you're going to see breakdowns where you wouldn't expect breakdowns. You have to have that bearish outlook on the technicals, if that makes sense. So here I have this, I would say this was kind of a trading range we were seeing here. We broke out. We've, of course, fallen back down. Let me see what that rising bottoms trend line looks like. Because I think we broke down. Oh, yes, we definitely broke down from that. There we go. So breakdown, a failed breakout, a breakdown from that rising trend that brought it there, and a PMO top. So, Tom, I'd have to say I don't like this one. I think it could even move all the way down to 70. I think 72.50 would probably be optimistic. So again, maybe a shorting opportunity here.
Yeah, I don't like it either. I was looking at it relative to its peers. It's been pretty poor performer relative to the S&P. Its peers relative to the S&P. So it's just not been a very good, doesn't look very good on the chart to me. Okay, let's take a look at WAT. They beat on their top and bottom line, and they guided fiscal year 19 higher, and they authorized a $4 billion share repurchase. So a lot of good news being released by WAT. What do you see on the chart?
I wouldn't chase it. I'd be really happy if I owned it, of course. Very nice.
I never owned anything like that.
Only every once in a while do I get that lucky. All right, I'm going to just put this really intermediate term declining tops trend line. We got the breakout on that, so we already had some warning. Have to say, you know, the PMO pretty much came in on this one. It did tell us what we needed to know. Notice that we had rising bottoms on price and rising bottoms on the PMO. That is considered a bullish confirmation. We got more confirmation when the PMO got over zero, and that happened up here in some of this consolidation. The PMO during that time still moving very quickly to the upside. So this one was really already looking very good, I think, technically. And now I have a 5,200-day EMA positive crossover, which would give me a long-term trend model buy signal. Of course, I wouldn't take any of those EMA crossover signals I wouldn't put that much confidence or weight on them, mainly because, as you can see, since May, the EMAs have been really just braiding amongst each other. So they've been moving mostly sideways, of course, makes sense given the price action. But I always am skeptical of the buy signals that come in, or the sell or neutral signals that come in when the EMAs are so close together. But I like that buy signal. We got it. We're getting a really nice acceleration upward. I think the stock looks good. The problem is having to chase it if you got in on it. And I don't know, what's the weekly chart look like? What are we getting for our upside? Yeah, really nice breakout. It's sitting at all-time highs right now. Maybe we'll see a pullback to that 220 level where it broke out, you know, the previous all-time high. Now there's something interesting here. This would be a reverse divergence. Notice the PMO bottoms are moving lower, but price bottoms are moving higher. And it's considered a reverse divergence, meaning that it's positive. So even though you have indicator bottoms moving lower, price bottoms are moving higher. So the PMO is able to unwind further. So,
sounds good.
So I like it. I just would, obviously, you'd want to wait on a pullback for this one.
Okay, well, that is it. Good job. Went through a number of stocks that did have some news. So those were our spotlight stocks for today. Maybe you found some of those worth considering for trades going forward. But yeah, we got, I don't know, maybe another minute left. I can say that the market has bounced back off of its earlier low. Wouldn't exactly say that it's flying, but we do have the Dow back in positive territory, up 67. The NASDAQ right now is down 20, and the S&P 500 is down 4 points. And there is kind of the summary.
The rising wedge did execute yesterday, and it's still, that rising bottoms trend line is still broken. So 2,600 for support. We'll have to see if we get the bounce.
Yeah, I think you're talking about these bottoms right here on the S&P. Yeah. So yeah, the whole idea here is you got a downtrend. And I know Arthur was talking about this as well, where you connect the higher lows, you connect these higher highs, and it's like a piece of pie. It's like a wedge. And this action here has broken it. I'm still watching that rising 20-day moving average. I think that's going to be probably the most important thing that I'm going to look for in the short term. So far, all of our key sectors are holding it. Our major indices are holding it. So it's a little scary seeing the selling kick back in, but I think we're still okay at this point. All right, I do want to mention I'm going to be out for the next few days, but I'm going to be doing a little vacationing with my family down in Florida. But I know we have some great co-hosts for Erin coming in. We got Arthur Hill. And then, of course, Mary Ellen will be in on Friday. Greg comes in on Monday. A lot of good stuff coming up. Just wanted to make sure everybody's aware of that. I do want to thank everybody for stopping by. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. And Erin and some guest hosts will be seeing you the next couple of days. Happy trading.